My view would be let's start the taper and let's do it quickly. Let's not have this linger. I think that trying to get this done as quickly as possible will be the best approach, and I'm not really expecting it to upset markets in any significant way.
There are some transitory factors, but there's also some evidence that they may not be so transitory, and that's a risk that I'm worried about.
Let's bring in Jim Paulson, Chief Investment Strategist at the Luthold Group, and Priya Misra, Global Head of Rate Strategy at TD Securities. Priya, I'll start with you. In your view, has there been an actual shift in the tone of the taper? Wow, tone of the taper timeline. That's a lot of alliteration. But has there been a shift in your view? And if so, should the markets take that in a negative way or in a positive way?
Well, I think risk assets should take that in a positive way. So I would argue there has been a shift. A few months ago, the market was looking for the Fed to for Chair Powell to outline the entire taper timeframe at this meeting. I think what we've heard in the last couple of months is that there is no urgency for the Fed to start the tapering, and they're trying very hard to disentangle tapering from tightening. So they're trying to say that even though they're likely to taper by the end of the year, and that's the message we think we hear from Chair Powell today, that they're not in a rush to exit from accommodation. And why I think that's positive for markets is I think markets are concerned about the economic outlook as much as the Fed reaction function. So I think Chair Powell has this delicate dance that he has to say that we're exiting, that the Fed is exiting, but with the timing, the pace, the plan, which is not going to be disruptive. It's not going to result in a recession. They're not going to slow things down that fast, because I think people are actually concerned about the economic outlook with the surge in the Delta variant.
So I don't know whether I need to ask you, Jim, because I actually was referencing some of your previous comments to me about interest rates being not necessarily when they go up, that it's bullish historically, as long as it goes up sort of orderly back to 3, I think. You said 3 or 4%, and it can be very bullish for financial assets. So do you think this is a positive that the Fed is at least sort of telegraphing that they know they're supposed to have 2 mandates?
I think it is, Joe. I think the market would be fine if the Fed here soon starts to taper. I think they've well discounted already, and they're prepared for it. A lot of the markets adjusted already. Small caps have been flat for months. Cyclicals have rolled over. Commodity prices have rolled over. So I think what's interesting is I don't see the Fed is not under a lot of pressure. We don't have surging bond yields pressuring the Fed, or surging break-even rates, or a collapse in the dollar or anything. We don't have intense inflation fear at the moment. But I think the market will do best if the Fed actually starts to taper before, they're forced to taper, if you will. And the market can deal with the taper when these other conditions are somewhat docile. But if the Fed truly waits until they're forced to taper because there's runaway interest rates or a collapse in the dollar, then the market's going to react much worse. I think if we get a taper the next couple months started, I think the market is going to react very positively to that, because it sort of starts to show that the Fed's concerned that they're going to start to top off inflation pressures, and ultimately that'll lead investors to think about an elongated recovery rather than a short stint.